It's not very often that I sit in an audience and listen to other speakers, and I did that a few months ago and heard Amanda and Matt for the first time, and I actually left my seat to go get Aaron. I said, "You have to hear this," because it was something I honestly didn't know that was just about to save us 50 grand, and if we did things right, we could actually save some more money. So that is pretty unusual for me, because I stay up on things pretty well, but there were some things that they said I didn't know. So that's why they're here today. Matt Macfarland and Amanda Han have almost 25 years of combined experience in taxation and accounting. Both have spent much of their career working for the Big Four CPA firms, serving clients of high net worth, business owners, professional athletes, real estate investors, tech companies, and international companies, to name a few. And Matt and Amanda also have just recently had their first child. So we welcome you to our program.
This is on. Can you guys hear me okay? Thank you so much, Bruce and Aaron, for putting this wonderful event together for us.
Yeah, we were joking that Aaron's probably one of the most detail-oriented and creative people we ever met, because I think we got probably 20 emails over the last week about the event, and okay, you park here, this is where your car goes, and so it was down to the T, so we like that, as accountants especially. But thank you again for everyone coming, and thank you for those of you listening online and watching online. We're going to talk about 2011 year-end tax planning strategies. And obviously that's why we take a break before we come up, because you guys need a break before you talk about taxes, right? We don't want to overload you guys. So, well, here's our quick agenda. We're going to talk about, for those of you real estate investors, or I know there's a lot of you in the room, we're going to talk about some new taxes coming out that you guys need to be aware of. It's going to impact your business, and we're going to talk about ways to get around those and avoid those as well. We're also going to talk about tax-free and tax-deferred income investing strategies with retirement planning, because we all want to keep more of what we're making, so why aren't we putting it into retirement instead of giving it to the IRS, right?
Yeah, so we're going to basically add on to more of the tax side of what Karen has just shared with us with respect to self-directed investing and other retirement investing in general.
And we're going to talk about tax reduction strategies for 2011 and specifically year-end. There's only 2 months left in the year to make moves now to save taxes for 2011, so that's what we're going to be talking about. We're also going to talk about tax-efficient ways to extract profits from your business or investments, because everyone always wants to hear about these things, and that's why we're going to touch on that. And at the end, we're going to kind of wrap it up, bring it all together, and talk about all the things that we learned today and how you can use those going forward.
So as we get started, we want to put you guys to work first, and we're going to start with some pop quiz questions. And so the rules are, and you have to follow the rules, okay? Whoever raises their hand and answers these questions correctly, you will get one of our gift cards, okay?
So the first question, I don't know if you can read that, but...
Oh, no. Wow.
All right,
I hope the rest of the slides aren't like this.
Yeah. So the question is, which of the following celebrities went to prison for failing to file tax returns? Right now, we haven't even given them the choices over here yet.
Yeah, didn't follow directions.
You can't. It doesn't count if you've seen us speak before. Come on. So the first choice is Tim McGraw, Lamar Odom, Tom Hanks, or Wesley Snipes.
Who do you want to call on?
Oh, we'll go with the young lady right here. Yes. Wesley Snipes. We got a winner.
Yay! Oops, sorry. All right, Heidi.
All right, our next pop quiz question is, the IRS allowed which of the following people to take a tax deduction for their breast implants after a court hearing? First choice is Dolly Parton.
Remember to raise your hand.
Lindsay Lohan. Chesty Love. Or our last option is D. Bruce Norris.
Oh, the lady in the back, middle back.
That's you, yeah.
That's like
Chesty
Love. Wow, good job.
Usually, obviously, Dolly Parton and Lindsay Lohan, those are popular
choices. Good job,
choices.
really good.
When actually Amanda put this together the first time, I didn't know who Chesty Love was. I thought that was totally made up. I was like, come on, that's too good, right? That's too good to be true. But if you actually go to Google and type in her name under Google Images, you will see what we're talking about. But what's the best part about that, though, right? It's not that she got to write off her breast implants, but did the IRS allow her to write them off all in the first year? No. She had to depreciate them because they're fixed assets and they have a useful life of longer than a year.
So that's Matt's favorite slide, just so you guys know.
I might talk about that later too. It's just.
But really the whole point of that slide was to show you guys that there's all sorts of things that are tax deductible items, okay? It's going to depend on each specific taxpayer. So if it is with respect to your business or your investing, then most likely those are going to be tax deductible items.
So and our last question is more of a serious question. It's just curious as to how many people in the room think taxes are going to go up in the near term future? Are there any of you who actually think it's going to go down? And you can be honest, it's okay. So it's a prevailing theme that, yes, the taxes are going to go up over time. And one of the things that we talk about is, well, let's talk about what the quote-unquote low tax rates are right now, right? And we say that facetiously because at the end of last year, taxes were actually set to go up. But right now, the highest... So I wasn't making up the names, I swear, they're right there. It is still Chesty Love, that's right. So these are our current low tax rates. The highest federal income tax rate right now is at 35%. And for all of us who live in the state of California, our highest rate is close to 11%. And if you're self-employed, you have a business, you work for yourself, you're looking at payroll taxes of about 15%.
Well, or if you're an employee, you're also paying payroll taxes for half of that, about
Right.
7%.
Now, a lot of you are real estate investors. What happens when we sell real estate? You got to pay capital gains taxes, right? That's included in there. And also, if you die without a good estate plan in place, you're looking at estate taxes of 35%. So we talked about how a lot of us, a majority of us think taxes are going to go up, but now politicians are smart, right? They're not just going to try and just increase the rates because that's not politically correct way to do it, right? What else are they going to do? How else are they going to raise taxes? You could lower the deductions, the exemptions, the credits, take away credits.
Change the brackets.
Change the brackets. But one of the things that's currently in place, they're actually going to create new taxes that's going to add on to these current low tax rates. So let's talk about these. Anybody recognize this man here? Any Back to the Future fans? This is the great Doc Brown. He's wearing that contraption of a hat that he uses to conjure up new ideas. And so we think there's somebody in the back rooms of Congress or the IRS who's doing the same thing with taxes. They're coming up with new taxes that you guys probably haven't heard of. It's going to be hard for you to remember the name. But the first one is the unearned income Medicare Contributions Tax. Exactly. How many of you actually heard of this? Okay, Jim, you don't count, but...
Presenters don't count. People who've heard us before don't count.
Yeah.
All right, so the Unearned Income Medicare Contributions Tax, it has a very long name. I think that's probably why the media doesn't talk about this too much. It's hard to say that in a sexy way. And it's very misleading because most of the people think that this doesn't apply to me, right? Is it on Medicare income? Is it on some sort of contributions I make? But no, essentially, this is a tax of an additional 3.8% that's going to be effective January 1, 2013 on net investment income. So what's net investment income? Anyone want to tell us some examples?
What about interest income?
Interest income? Do we have money in the banks earning interest?
Doing
Okay.
notes or trust deeds, earning interest?
What about capital gains? We have real estate investors in here. Okay, when you sell your property, you're going to have capital gains. That's considered investment income. That's potentially subject to this additional 3.8%.
What about net rental income, right? If you end up with positive taxable income from your rental properties, that's going to be subject to this new tax as well.
Dividends, capital gains, rents, basically, you know, anything that you're investing for, the returns that you're generating, that you're getting a return on investment is considered net investment income. And so the way we look at this, because we work with a lot of real estate investors, what we typically tell our clients is let's simplify this. Let's not call it unearned Medicare contributions tax. Let's just call it a new tax on real estate investors, right? Because at the end of the day, that's essentially what it is. And keep in mind, this is 3.8% in addition to all of the other taxes that we just talked about on the other slide. So now you might say, okay, maybe I don't invest anymore. I'm going to just start working for my money, right? I'm going to spend more time on my business. But this is where Doc Brown came up with his second brand new idea, which is the hospital insurance tax. Again, this is not assessed on hospitals or insurance companies. This is assessed on you and I, okay? And this is on earned income. So what's earned income? Anything that's not investment income. So they got you either way.
1099 income, all that stuff.
So that's another 0.9% on top of earned income.
Yeah, so obviously you can see if they're not getting you with the investment income tax, they're going to get you with the earned income tax, right? Because these are basically the two ways that most people are earning money or making money. And again, these taxes go into effect January 1st, 2013. So you do have some time to plan effectively for these. And we are working on a dozen strategies to help our clients avoid this, minimize the tax, get around it, delay it, whatever we can do to make sure our clients don't wake up on January 1st, 2013 and have another 4 or 5%, close to those, in new taxes on top of their already existing tax rates.
So now today we're talking about year-end tax planning. Let's talk about a strategy where you can start to protect yourself from both of these brand new taxes. And that's just right in line with what Karin had just talked about, which is retirement investing.
Yeah, with retirement investing, the idea here is to take the money that we're making and put it into retirement, either tax deferred or tax free. But this is a great way to avoid that 3.8% tax on net investment income, because any money that's being earned or any income being earned inside your retirement account is free from this tax. And also, if you're getting to the point where you're close to having to take distributions out of your retirement accounts, those distributions that come out are also free from this tax. So what a great way to use your self-directed IRA, your self-directed retirement account, to invest in things that you guys are comfortable with, things that you have an advantage over, like real estate, businesses, whatever the case may be, and avoid that extra 3.8% tax.
So with respect to year-end, one of the things we look at, especially in looking at a long-term approach of how, because the new tax that's going to be effective in 2013, is probably going to be a tax that's going to stay with us for a while. And so one of the things that we want to take a look at from a long-term planning perspective is why not stock away money in a permanently tax-free bucket? Right, and what we're talking about is Roth retirement accounts, Roth IRAs, Roth 401ks, the truly tax-free bucket. And this is a really great time to talk about this because, a lot of clients, whether, you're a business owner, maybe real estate investor, is that the economy has changed so that we have a lot of people who have underwater properties, negative cash flowing properties, where you're having a lot of losses on your tax returns. And so what we hear a lot when we talk to people is they say, I have losses on my tax returns, I don't really need any tax planning because I'm not paying any taxes. But on the contrary, right, because you can use your losses to shift your current retirement account into Roth accounts and start generating returns from that truly tax-free Roth bucket.
Yeah, we had a client just a couple years ago that actually had that exact scenario. They had invested in a property like a lot of us that didn't turn out so well, so they disposed of the property. They had to take a big loss on it. But for them, they didn't need the loss at the time, so they were carrying it forward. Well, the next year we were working with them. It was like, well, why don't we convert $200,000 from your traditional IRA to your Roth IRA? And for them, because they had that loss carry forward, it wiped out all the income. So for them, they were able to convert $200,000 to a Roth IRA, essentially tax-free out of pocket to them. And so now they have their Roth IRA that's investing in real estate. They chose apartment buildings. So they're all that monthly cash flow they're getting and all the future gains when they sell the property are going to be tax-free for the rest of their life. And also we're working with them on a legacy plan for them where they're going to be able to stretch the benefits of this Roth IRA to their kids and their grandkids so that they also get tax-free income over their lifetimes.
And their daughter is 5 years old, and Bruce just said Matt and I, in case you didn't know, we're business partners, but we're also husband and wife too. So we just have a 2-month-old, and that's what we're looking at for our retirement account, to ensure that the rental income, the future appreciation from that we get tax-free treatment, not just for the rest of our lives, but to be able to stretch that over the lives of our kids as well. Okay, so that's really, really powerful when you think about that. Think about no federal income taxes, no state income taxes, no new unearned income Medicare contributions taxes going forward, right?
So either way, whether you're using a quote-unquote traditional retirement account that you're getting a tax deduction for the money going in now and it's growing tax deferred, or you're looking at using a Roth bucket to really start that tax-free money, that tax-free bucket, because taxes are going up, it's more important than ever to really start building that tax-free bucket. There's lots of different plans out there. Some, as Karin was alluding to, some have, a lot of people think you can only put in $5,000 a year to a retirement account, but there's some plans where you can put in up to $49,000 a year. We have some clients who are utilizing defined benefit plans and putting in $100,000 a year. So it does depend on your situation, it does depend on your business, but there are things that you can do. And with a lot of these different plans, here's the key for year end. Some of these do need to be set up by December 31st. Now, some of them can be set up and funded next year and still get a deduction for this year, but some of them actually have to be set up and funded this year. So these are things you want to talk to your tax advisor about when you're meeting with them for year-end tax planning. Is don't just wait till April next year and think that you can still do something with a lot of these retirement plan options.
Yeah, because what you're looking at is, at the end of the day, would I rather pay money towards the IRS, or would I rather redirect it into my own retirement account and use that for tax-deferred growth for myself and my family? And another thing I just want to mention with respect to year end is the Roth conversion. What you can actually do, and I encourage really all of you to take a look at this before the end of the year, is to say that maybe I want to do the Roth conversion. Okay, so before December, I take the money in my retirement account and I convert it to Roth. Now, if I don't have losses, most likely I'm going to have to pay the taxes on it, right, when the tax returns are due. But what the IRS is offering actually is what we call a risk-free trial offer. So what if you were to convert, you have a rental property.
Sounds like late night television or something.
Risk-free trial offer, act today, run to the back of the room. So let's say you have a property that's worth $100,000. You do a Roth conversion, you pay taxes on it at the fair market value. And let's say, 4 months or 6 months from now, it's worth $200,000. So was that a good decision for you to convert? Very likely. You just made $100,000 of tax-free money. But what if by 4 to 6 months, your property is close to zero value or $50,000? Then that was a bad move, right? You don't want to pay taxes on it if it's gone down in value. But the IRS actually says, hey, you know what? You can change your mind. Okay, so you make a Roth conversion before the end of this year. You have all the way until October of next year to confirm whether you thought you made the right decision or not. There's no penalties for doing that. There's no taxes for doing that. There's no interest for doing that. So that's what we like to say. It's a risk-free trial offer. Make a conversion. See what happens to the market. See what happens to your investments. What do you have to lose, right?
Exactly. So this says, what is year-end tax planning? And we'd like to kind of give you an example of this. I don't know, this is actually a timely example if you guys have been watching the World Series. What happened in Game 6, right? Rangers are up. It's the bottom of the 9th inning. The Cardinals are down to their last strike. So for all intents and purposes, this game is over. But the Cardinals come back. We go to the bottom of the 10th. Cardinals are down to their last strike again. They come back again.
You're going to give us a play-by-play?
I might.
I think he wants to relive the game.
I'll tell you the hitters. And then the 11th, they obviously won the game. So the point is, obviously the game's not over. Who the winner is determined by when the game is over. Same thing with taxes. What your numbers look like on December 31st are for the most part going to determine what your tax situation is going to be for this year. So that's why it's important to look at doing proactive tax planning to see what you can do now and in the next 2 months before you hit the 12/31 mark so that you can save taxes for this year and potentially for future years as well.
So a lot of the strategies we talk about, we're gonna talk specifically about year end or what you should consider doing before the end of this year in terms of minimizing taxes for 2011. Okay? Because now is a much better time to plan for this than January or April of next year, because by then there's a lot of these strategies that you can no longer use legitimately. Okay?
Or also, if you're going to meet with your advisor like next week or in mid-November, please don't wait until like December 27th to call them back on their recommendations and figure out what you should be doing, because your advisors may actually like to take vacation during the last week of the year too. So the first strategy we're going to talk about is income deferral. And for you real estate investors and business owners, this is a great way for you to look at reducing taxes now and in the future. Because thought comes to mind is if you could defer income, and again, we're talking about year end, so if we're looking at December 31st, you could defer income by just one day into January of the next year. You could defer the taxes associated with that income for an entire year, right? Because generally the income you make this year, you're going to pay taxes on it in April next year. But the income you make in January next year, you're going to pay taxes on it in April of 2013. So think about that for your business, because we just actually met with a client, Dorothy, last week, who she's a real estate investor and she's looking at selling one of her properties, and she said, well, this is going to close mid-December. And she's going to have a $80,000 gain on it, so she's going to be paying some taxes. I said, well, is there a way that you could not kill the deal, obviously, but is there a way that to defer the sale to happen January 2nd or January 1st? Because she's still going to get her money, and it's only 2 weeks. But for her, she's delaying the taxes on that $80,000 for an entire year. So that's powerful. And again, you don't want to do anything that's going to kill the deal, because taxes shouldn't be leading the way in any of your decisions, but it should be part of your decision. So for her, that makes a lot of sense. Now, another strategy is, in addition, as business owners and investors, instead of just delaying taxes, what if there was a way that we could permanently reduce your overall taxes by using income deferral? Would that be, anybody like to hear that? So another client of ours, Sandy, she has a short sale business, and she did this in 2010. She had a really good year. She had sold a lot of properties, and she was coming up on her last one. She was looking like she was going to close her last deal, and it was going to be about a $50,000 profit. And so if she was going to close on that sale in 2010, that extra $50,000 would have pushed her into the 33% federal tax bracket from 28%, so increasing her tax by 5%. So we worked with her and looked at her 2010 year, we looked at what she expected in 2011, and she was able to defer that sale to close in 2011. And the benefit to her was that in 2011, she was still going to be in the 28% bracket. So she was able to avoid altogether a 5% tax on that 50 grand. So that saved her $2,500 just by that little shift that she did. And again, it didn't kill the deal. She was able to make it work with everybody involved. And again, it saved her $2,500. So it's definitely worth looking at. So hand in hand with income deferral is we also talk about accelerating expenses, right? Because just as deferring income may save you delay taxes for a year or save you altogether, if you can push up expenses into this year, it may save you taxes this year, and it may save you taxes permanently again, depending on your tax bracket.
Yeah, I think some common expenses, what we typically tell people to do is look at your business plan, look at your projections, look at your budget, and think about what are some expenses that you think you're going to incur early next year. There are a lot of businesses or real estate business, all sorts of businesses that do a lot of marketing at the beginning of the year, right? So if you know you're going to incur marketing expenses, for example, you might want to accelerate that and pay for it the end of December rather than paying for that in January, because that means now you then can take a deduction for that expense on your tax return a whole year earlier by accelerating that just for one day. Other things that come to mind: property taxes, insurance, recurring fees that you might be paying to your bookkeepers or your attorneys.
If you want to pay your CPA a year in advance, that's okay too.
You can pay your CPA 3 years in advance. Take a tax deduction. And that's correct. I like you. All right. And so the key here to keep in mind, obviously, you're looking at expenses that you would otherwise incur anyways early next year, right? So it's just shifting some funds around. And also, I think for most taxpayers, you don't even have to have cash out of pocket to take the deduction, right? As long as you're charging it on your credit card, then that generally is going to be a business deduction this year. Okay?
Regardless of when you pay off the credit card, so you could pay that off 4 months from now, whatever the case may be, you're still going to get it this year because you charge it to the credit card.
Yeah. Well, I was going to say, expense acceleration is always a good strategy. It's the exact opposite of income deferral. But with respect to 2011, this is especially important because of a tax break that we currently have that's going to be expiring as of the end of this year.
So what we're referring to here is the 2011 bonus depreciation opportunity. How many of you guys are familiar with bonus depreciation, or the idea, or heard about it, read about it? All right.
So the bonus depreciation for 2011 is that for all of us who are buying new assets for our businesses, that you can take a dollar for dollar write-off, 100%, in the year of the acquisition. So Matt talked about breast implants for Chesty Love, had to depreciate it, blah, blah, blah. So if Chesty would have had his asset purchase in 2000, hers, maybe his, I don't know. If that asset purchase was done in 2011, then she wouldn't have to wait to depreciate it over multiple years.
So a strategy for Chesty Love.
So the question is, you have to do it in 2011, and the answer is yes. The asset itself must be purchased in the 2011 year. This loophole is set to expire as of the end of the year. So
kind of just put some numbers to it. We were working with a client of ours, Christopher, last year, and he came to us during year-end tax planning, and this actually rule came out in effect of September 2010. So for the last basically 3.5 months of 2010, you could have implemented this strategy as well. And so we were sitting with him during the year-end tax planning. He was saying, well, he's got a profitable private lending business, and he was looking at needing a new company vehicle, and he was trying to talk his wife into one of those large Lexus SUVs and trying to come up with some ways to justify spending the money for that, right? But after we met with him, he said, well, if you can justify that this is majority business use or a large percentage, and you're buying a brand new one, you may be able to write off a dollar for dollar cost of that vehicle.
And that was an $80,000 car?
Now, obviously, that conversation was a lot simpler with his wife at that point, right? So he went out and bought this $80,000 SUV, and for him, he could justify it was 100% business use because he bought it last month of the year, and he made sure that he was using it 100% of the time for business. And so that saved him about $40,000 in taxes. So the net cost of that vehicle was, in essence, $40,000. Again, a lot simpler of a conversation to have with your spouse if you're really trying to sell this to them.
And what I love about the bonus depreciation is, for any of you guys who've looked into deducting autos, you'll know there's a lot of limitations in terms of how much you can deduct, the weight of the auto. Luxury autos, there's also lots of limitations. And so with the bonus depreciation in that example, it was an SUV, so it's still subject to the weight rules. But there's no dollar amount of limitation. So in this example, if Christopher would have gone out and bought a Lamborghini or a Porsche, for example,
or a Honda Accord or whatever,
then he would have been able to take dollar for dollar write-off without any limitation. And the other thing to look at is, some of you might know, a lot of tax loopholes, they come with a lot of limitations, right? So there's other sorts of immediate write-offs where you have to be a company of a certain size. You can't have income or assets over X million of dollars, or you have to be profitable to take a write-off. The best thing about the bonus depreciation is there's no limits. So this is available for companies who make $1,000 a year. This is also available for companies who make $1 billion a year, and for companies who've lost money as well. Okay? So this is what we love about it. But the important thing for you guys to take away from today is that this strategy is like milk. It has an expiration date. And that date is? Good.
They're good. And then also a couple other tidbits is that this applies whether you buy it cash purchase or you get a loan to buy the car. So if it's finance, this still counts for the entire purchase price. Just like real estate, you depreciate rental real estate using the entire purchase price, right? Not just your down payment. Mm-hmm. And this also applies to other assets you could buy for your business, furniture, equipment, cell phones, desks, whatever the case is.
Yes, for real estate investors, this also applies to certain types of leasehold improvements as well.
So yeah, make sure you're talking, if you've got commercial properties and you're doing leasehold improvements, make sure you're talking to your advisor about this because you may be able to write off 100% of the cost of those improvements this year.
The question is, does the vehicle have to be brand new? And the answer is yes. So the limitation with bonus depreciation is whether it's a vehicle, a piece of computer, any sorts of equipment that you're buying, it does have to be brand new and not just new to you. The second question we get often is, Do I have to pay for it in cash? And the answer is no. You can definitely finance the purchase of this car. So for our client Christopher, he certainly did not go out and pay $80,000 for that car in cash, right? So it has to be a purchase. It cannot be a lease. With respect to a car, it has to be a purchase. And same with furnitures. You know, if you have to buy the furniture, it could be on credit, but you have to purchase it. You can't be leasing furniture and take the bonus depreciation. Okay. And yes, and the question is it 100% business use? Yes. So, I mean, as with anything, you can take a business deduction to the extent it has a business purpose and is used for businesses.
Right.
Okay?
Now, we were talking earlier about accelerating expense. Another idea came to mind wanted to share this because I know a lot of you are real estate investors. We had a client that was looking at, near the end of the year, was looking at replacing his roof. And he needed to kind of more or less replace the whole thing. And, you know, generally the IRS is going to say anytime you replace an entire roof, regardless of whether it's got holes in it, they're going to want to argue that you need to write that off over the life of the asset, like 27 and a half years, 39 years, whatever the asset itself is. But for him, we were able to work a strategy that, well, why not in the end of the first year, why don't you replace parts of the roof?
So that could be a repair.
So we were going to treat it as a repair because he's not fixing the whole thing. And then near the beginning of next year, he was able to fix the other part of the roof. So he's straddling 2 tax years, which is a good thing in the tax world because the dollar amounts look smaller. He can argue that he's able to substantiate that this part that he fixed in the beginning of the end of the first year, there were some things he had to fix on it. There were some holes, it was leaking, et cetera, et cetera. So for him, he was able to basically accelerate that write-off from 27 and a half years to over a short 2-year period. So again, I just wanted to mention that because that was a big one that he really liked and it worked really well for him. So any of you guys may find yourselves in that situation. So let's talk about tax-efficient ways to extract profits out of your business or your investments. And this is just kind of a sexy way to say, how are you taking money out of your business or investments? In essence, do you have a strategy in place to do this? Are you doing it by default or are you doing it by design? So what we mean here is that one of our clients, Benjamin, he has an S corporation. And his business is one of those, it's a B2B business. And so he helps other businesses find ways to reduce expenditures. So obviously over the last couple of years, his business has flourished because in the downturn in the economy, everybody's looking for ways to save money, right? So his business has flourished. And when he came to us, he was making well over $200,000 in his business. But the catch here, he was taking it all out as salary.
Well, he was taking it out to basically accommodate his lifestyle, right? Taking the money out as payroll to pay for the house by the beach, to pay for his car, to pay for all the things that he enjoys in life. And so one of the first questions we talk to new clients about is, how much are you paying yourself, or how are you taking the money out, and why are you doing it that way? And if they don't know, or they say, well, this is what I need to live off of, then that's how you know that you need some strategies in place. Okay? Because how you take money out of your business or your real estate determines how much taxes you're paying.
Yeah, so for him, he was taking it all out as salary. So he was paying the highest rates possible. He was paying federal income taxes, he was paying state income taxes, but he was also paying payroll taxes on the entire amount. So we worked with him with some compensation planning to legitimately reduce his salary down to a reasonable amount. And for him, that saved him over $7,000 a year in payroll tax savings. And that's just the first year. I mean, this is in place for every year thereafter that his business is profitable just like this. So that's one strategy we did with him in terms of extracting profits out. Another thing we did for him is that we actually helped him create a C corporation, incorporated a C corporation into a structure. And so by doing that, he was able to shift $50,000 to a C corp each year, which has a low tax rates of 15% when you keep your income below 50. So he was able to save $10,000 on that $50,000 based on his tax rate differential and everything. But not only that, he was also able to utilize some of the fringe benefits that you only get with C corps.
So fringe benefits are a great way to extract profits out of our companies without paying taxes. And mainly we're looking at tax-free fringe benefits, where it's a deduction to your company, your business, and not taxable to you as the recipient side.
And so for him, we put those strategies in place. He's getting a lot of the fringe benefits. So for him, that first year, he saved about $21,000 in taxes. So there are things you can do. And again, the point here is to look at what you can do before year end. I mean, for those of you doing wholesale fix and flips, and if how many of you guys actually work out of a home office? A good majority now. How many of you are actually claiming your home office deduction on your tax return? Okay, so fewer, but we see that a lot. And the point here is if you do have a qualified home office, look at utilizing an accountable reimbursement plan that will allow the business to reimburse you for a portion of the cost of using that office. The business gets a deduction. It's tax-free reimbursement to you. And it's a great way to get deductions for the home office and also fly under the IRS radar in terms of the home office.
So tax-free way to take money out of your business, and your business gets a tax deduction.
Yeah, and that works. The accountable reimbursement plan, the question is, what about S corporations? And the accountable reimbursement plan does work really well for S corporations. So our last strategy we want to talk about is for real estate investors. Now, for you guys who are investing in rental properties, your best bang for your buck in terms of tax savings potential is going to be if you guys can qualify as a real estate professional. How many of you have heard of this term?
And I just want to clear up a myth about real estate professional. This is the most common myth I hear is people think that they have to be, in order to be a real estate professional, they have to get licensed as a realtor, work under a broker. We actually just met with new clients last night that said, oh, I'm taking classes, I'm trying to qualify for the real estate professional. We said, what classes are you talking about? You don't need to take classes. The real estate professional status is nothing more than a tax designation. Okay, only the IRS cares about this definition. And it has nothing to do with what your professional licenses are that you hold. All the IRS is looking for is what are you doing with respect to real estate? And there's two criteria that you must meet, and you must meet both of them. The first one is you have to spend at least 750 hours per year in real estate related activities. And there's a whole long list of real estate activities. I would say that all of us here today on this Saturday morning, this is real estate activities, right? We're all talking about real estate. The second criteria is that you have to spend more time in real estate than you do in your other job or business combined. Okay? So again, by the definition of the IRS, these are the two things they're looking at. They're not looking at whether or not you're licensed as a realtor or a broker. But the one thing is that this is probably the most costly and common tax mistake that we see all the time, is in tax preparers not knowing what is the real estate professional status and how to claim for that appropriately on your tax return to get unlimited tax benefits from your real estate to offset your other sources of income. For example, earned income, income from your jobs, your businesses. And so the reason that this is one of the most common mistakes is that it's not a very clear-cut way to claim for this benefit. So we can't stand here and say, hey, you guys need to fill out form, XXYZ, or you need to check the box on page 4. Okay? So there's no form to fill out, there's no box to check. Rather, it's an election that must be attached with your tax return that says that I'm going to claim as a real estate professional. Okay?
And generally, there are some things in the tax world that if you mess up on or you make a mistake, you can fix it by filing an amended tax return. This is one of those that you actually can't fix by doing that. So if you wanted to claim real estate professional status and you didn't, then you can't go back and file an amended return. So you want to make sure that you're working with someone who understands real estate, understands the rules, and more importantly for year end, start documenting your hours if you haven't already, and sit down with your advisor and figure out if there's a way that you can qualify as a real estate professional. Can you meet those two tests? Mm-hmm. Because it's a lot easier to do this now than next April or next October if you extend your tax returns. And we've seen clients try and do that, and they start yelling at us and cursing our name for some reason. So.
And we do this all the time where we review people's tax returns. We find out they didn't correctly claim the real estate professional status, and it's not good for me to be the person to have to tell them, hey, you lost out on $10,000, $15,000, $20,000 of a tax refund because you're didn't prepare it correctly. And there's nothing I can do to go back for you and get that.
Yeah.
Okay, so make sure you look at that before year end. And I want to invite all of you, we just released our 2011 ebook on 5 cash flow strategies for real estate investors. So we talk about entity structuring, we talk about how do you legally shift personal expenses into legitimate business deductions. We also talk about the number 1 most costly and common tax mistake, which we just shared. So for more details on that, you can definitely read it in the ebook. So it's a pretty easy read, nothing that's going to put you to sleep. And if you want to get a copy of that, we do have postcards out at our table outside. And for those of you joining us online, you can download it from our website, which is KeystoneCPA.com.
So we talked about a lot of things today. We talked about some of the new taxes that are coming out for real estate investors and how you can avoid them. We talked about utilizing retirement accounts to either defer taxes or build tax-free buckets and maybe utilize some other strategies to combine some things. We talked about income deferral, accelerating deductions. We talked about the special bonus depreciation. These are a lot of things you guys can look at from now until year end to see if you can implement them in your business. We also talked about ways to extract profits from your business using salary and compensation planning, maybe utilizing a different structure.
Make sure you're asking yourself the question, which is, how am I taking money out of my business and or my investment? And why am I doing it this way? Okay.
So I think that's it. We thank you for your time. And again, our website's up here, our phone number's up here. If you guys want to call us and have any follow-up questions, we're happy to answer your questions. We'll be around for the Q&A portion of today. So, and we're in the back. So thank you.